What's going on, you guys? My name is Zach Hartley, and in this video we are going to talk about the strategy of averaging down. We're going to go over when it is a good idea, when it is a bad idea, and some other strategies and tactics that you may want to consider. I'm going to give you everything you need to know. Here we go. Okay, so averaging down is really simple. It's when you buy into a company as the stock falls so that you can lower your average stock price. Now, obviously, as soon as you buy into a company, we all want the stock to go up, but when the stock goes down, you have two decisions. You can either cut your loss or you can buy more into it, and that's called averaging down, and that's what we are going to focus on in this video. All right, so let's look at an example. So you buy 100 shares of company XYZ at $1, and then a month later, the shares are now trading at 80 cents. So you can either cut your loss or you can decide to average down and you can buy a little bit more. In this case, we buy 100 more shares at 80 cents and we do the exact same thing 1 month later at 70 cents. At the end of this, it leaves us with a result of owning 300 shares at an average price of 83 cents. And so the idea here is you made your initial investment at $1 per share. Now you're into it at 83 cents per share. So you're a little bit lower and you've averaged down as you've built a bigger position. We are going to talk about when that's a good idea and when that's a bad idea. So first of all, this is just my opinion and this is for entertainment purposes only. You need to do your own research and make your own investment decisions. So when is averaging down a good idea? Well, the answer to that is really simple. It is usually a good idea to average down when the asset that you're averaging down into is generating you cash flow. So if it's a $100 stock that is paying you $5 in dividends and the stock price all of a sudden falls to $90, but it's still giving you a $5 dividend every single year, then all of a sudden that stock has just become on sale and you are much better off averaging down because you are actually getting the same level of cash flow at a discounted price. You actually have value and incoming cash flow that you can base your valuation off of, and in this case you're actually getting a discount on that price as long as you're happy with that dividend or happy with that cash flow, and the situation or the support and the security of that cash flow has not changed. So if we are not forecasting that that dividend is going to get cut or that dividend might get removed, then that is a good purchase and you should be averaging down into that. Two examples of this are dividend paying companies and real estate investment trusts, or REITs. If you want to learn more about those, I did make a video on REITs as well. But the idea here is cash flow. If the asset is generating you cash flow, I totally support and I recommend averaging down into it as long as your portfolio remains balanced. That is the caveat there. You do not want to have all of your eggs in one basket. You do want to be diversified. But if you do have an appropriate level of diversification, I fully support averaging down into an asset that provides dividends or cash flow. Okay, so now when is averaging down a bad idea? Well, in my opinion, averaging down is a bad idea anytime that we are dealing with young companies, anytime we are dealing with companies that do not pay dividends, or anytime we are dealing with companies that do not have any direct cash flow going back to shareholders. Now, there's three reasons why I do not recommend averaging down into young companies or companies that do not pay dividends. Number one is position sizing, number two is time value of money, and number three is the risk return ratio. And I'm going to justify all three of these to you right now. Okay, so the number one reason is position sizing. If you get 2 or 3 investments into a company and it continues to fall, how do you manage the rest of your portfolio? Position sizing and diversification becomes very challenging because if you continue to increase your position size in that losing company, what ends up happening is you not only have a larger and larger loss, but you have more and more eggs in that one single basket. You have a larger portfolio of your cash in that one single stock, and so therefore you are less and less diversified. You have a larger and larger weighting in one particular stock, and you are now missing out on the other opportunities that are out there. That leads us to point number 2. This is time value of money. Time is valuable. You need to understand that. If you just hold $1,000 in cash, you're going to lose about 2% per year to inflation. If you had just invested that cash into a Canadian GIC or even an American GIC, you could make at least 1.5% completely risk-free. So just that value of time right there between inflation and making 1.5% is about a 3.5% difference just based on where you decide to put your money. And if you decide to put your money in a losing stock, you have made that difference even significantly larger. Therefore, it is much better for you to cut your losses early, invest that money into at least a GIC, if not a winning stock, and then when your stock that you are looking at averaging down into actually finds a bottom and starts to turn around, that is when you should put your money into it, because otherwise you're tying up more and more of your money over time that is just going to average down and lose money instead of either keeping putting it in cash and losing 2%, or putting it in a GIC and making 1.5%. So there is time value in your money. The more time that your money is tied up in a losing stock, the more money that you are losing, because you are not making money, you are risking the opportunity cost. Now, the last point that I want to talk about is the risk return ratio. So this one is really important, and this is actually the biggest factor for me. So as you average down, the more times that you average down, the risk return ratio gets worse and worse and worse. And so I'm going to break that down for you in an Excel sheet so you can see exactly what I mean by that. So let's use an example, and we have to make a couple of assumptions for this. So let's say it is a $5 stock that loses 5% per month. So it starts at $5 and then it loses 5%. And you could say that this is per year, per month, whatever time frame you want. This is just an example. And so the stock loses 5% per month, and you invest $500 per month, averaging down into it. Now, again, you can extend this out over any number of time periods or however long you want, but this is what the math looks like. So there's a lot going on here. Let me just break down the columns for you quick. On the left-hand side here is the months. So month 1, 2, 3, if you want to use years, you can as well. This is the stock price at $5 and then minus 5%, minus 5%, minus 5%. We have an investment going in of $500 per month. This is our total investment by month. So you can see at the end of 12 months, we're at $6,000 in total investment. This is the number of shares we are purchasing with each and every single month. As you can see, it gets higher and higher as we go down because the stock is getting cheaper. And this is the total number of shares that we've purchased in total. So at the end of 12 months, this person will own 1,616 shares. Now, here is the important price here. So this is the average price. So obviously on your first month, you buy 100 shares at $5, your average price is $5. When you buy in the next month and the stock is 5% cheaper, your average price is $4.87. And obviously we can go all the way down here. Now, where the real math comes in here is the spread. This is the difference between your average price and the current market price. And what I'm trying to point out here is that the more times you average down, the larger the gap will be between the current market price and your average price. So for instance, well, let's say you average down using these assumptions 10 different times. At the end of the 10th period, your average price will be $3.93. However, the market price of the stock will be $3.15. And the difference there, the spread there, is 78 cents. And so now the stock has to go up by 78 cents before you can even break even. 78 cents on a company like this, that's $3.32, is about 20% of where it's at. And so you need the stock to go up by 20% just for you to break even. And the more and more times that it averages down, the higher and higher that spread is, and the higher and higher return you need just to break even on your stock. So as you can see, if you average down once or twice, it's not really a big difference here. But as you average down, let's say 12 times, there's an 87-cent difference between your average price and the actual stock price at the time, which is $2.84. So there's an 87-cent difference on a $2.80 stock. That's like 25-30% difference just because you average down. Now, obviously, this is an assumption. These numbers are just simplified. Obviously, this isn't exactly how it works, but this chart does explain that principle of the more times you average down, the larger that spread becomes, and it becomes harder and harder for you to make money on that stock. So what is my advice? Well, my advice is to cut the losers quickly. Get into a position, set a stop loss on it. If it crosses your stop loss, get out of that position quickly, take the loss, take it in your mind and say, yeah, I was wrong on that. I'm gonna wait for a better entry point now. And that's how you should handle these stocks, because what that allows you to do is have that money and keep that cash so that you can reinvest it into the next best opportunity instead of being tied up in an absolute loser. That is the goal here, is to maximize the return on your money, and you cannot do it if it is tied up averaging down. So the goal here is to free up your time and free up your cash. Find another opportunity. That is the best advice I can give you, is do not sit in a loser, get out, cut the loss, and find another opportunity that is going to be a winner. There is so much opportunity in the stock market right now. All you need to do is do some research, do a little bit of digging, and find the stump and find the company that fits your profile. So in summary, averaging down is not a good idea in most cases. The one scenario where it is a good idea is if it is generating you cash flow. So if a dividend is still secure and that dividend hasn't changed but the stock price has fallen, then I do recommend averaging down. But anything other than that, it's usually a bad idea. So you should cut the losers quickly, and then you should subscribe and like this video. It sincerely helps out my channel. And if you're interested in learning any more about the stock market, I do have a free course on Skillshare. It is linked below. You get a 2-week free trial, and then you have to sign up for a subscription. but you can cancel at any time. And so if you can do the whole course in 2 weeks, you get the entire thing for free. And if you're interested in opening up a broker, I highly recommend Questrade. There's also a link below for $50 in free commissions. And if you guys need anything else, I've also thrown my email down there. So if you have any questions, send me an email. I'd love to help you out, and I will talk to you soon. Bye for now.